Hi, I'm Balaji, and today let's talk about how financial markets have fundamentally changed. We need to have a serious talk about the big one. You know the story. Your parents or your older colleagues tell it like a war story. 2008, the great financial crisis.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets.
Back then, the market didn't just fall, it bled out for 18 agonizing months. It was a slow motion car crash where every time you thought we'd hit the bottom, the floor just fell through again.
The country's biggest brokerage, with 60,000 employees, had been battered by nearly $50 billion in mortgage-related losses.
It is definitely a very, very difficult time, and it's not going to get better quickly.
But look at your screen right now. It's 2026, and that version of reality, it's dead. It's a fossil. In the modern era, we don't measure recoveries in years. We measure them in weeks, sometimes days. We've entered the age of what I call the vertical recovery. If you've been sitting on the sidelines waiting for a proper 2008 style fire sale to get into the market, I have some bad news. You aren't waiting for a crash, you're waiting for a ghost. Today, we're going to break down the velocity thesis, why the bear market as we know it has been deleted from the simulation, and why the buy the dip crowd has become an unstoppable force of nature. If you think I'm being hyperbolic, let's look at the series of crises we've navigated since 2020. In the last 6 years, the system has taken punches that would have knocked out any other era of the market. We've had COVID-19, the sharpest drop in history. We had global supply chain shocks that made basic electronics look like luxury goods. We had the Trump tariffs last year, a 40-year inflation high, and interest rates being cranked up like a medieval torture device. And most recently, the Iran war, with $120 oil and threats to the world's most vital shipping lanes. Any one of these should have been a multi-year bear market. Instead, every single time, the market dipped, yawned, and hit new all-time highs. This has created a psychological monster. Institutional and especially retail investors aren't just brave now, they're conditioned. They've been Pavlov trained to believe that every shock is just a sale. The fear of the big one has been replaced by an even more powerful emotion, the absolute terror of being the only one left holding cash while everyone else rides the vertical recovery. Why are they so confident? Because they know they're playing with a cheat code. The real lesson of the last 6 years isn't just that the market is resilient, it's that the US government will not let it stay down. 2020 should have been 2008 on steroids. Instead, the Fed and the Treasury pulled a whatever it takes move that would have made 2008's bankers blush. They flooded the system with trillions in fiscal stimulus and aggressive monetary policy. They've essentially provided a global backstop. Whenever there is a systemic threat, the government effectively steps in to protect the wealth effect,
which is to use our tools to achieve maximum employment and stable prices.
Investors have realized that the downside is capped by government intervention, while the upside is infinite. It's transformed the stock market from a risk-based engine into a government-insured savings account. When the house is guaranteed not to burn down, everyone stops buying fire insurance and starts buying more furniture. Let's talk numbers. The M2 money supply currently sits at over $22 trillion. Here is the secret the doomers don't want to admit. The money didn't just vanish when interest rates went up. It's still there. It's parked in money markets, sitting in corporate treasuries, and stuffed under the digital mattresses of retail investors. Holding cash in 2026 feels like a guaranteed loss because of the permanent inflation reset. This creates a mechanical safety net. The US stock exchanges, the New York Stock Exchange and the NASDAQ, are bigger than the next 5 global stock exchanges combined. If you're an investor in London, Tokyo, or Mumbai, you aren't looking at your local exchange for safety. You're looking at Wall Street. US equities have officially replaced gold as the world's most reliable hard asset. As long as that $22 trillion is sloshing around, every 5% dip looks like a once-in-a-lifetime opportunity for someone. Now let's talk about the Borg. I'm talking about passive investing. In 2008, people actually had to decide to buy stocks. Today, the decision has been automated. We have essentially created a default distribution layer for the entire global economy. Every 2 weeks, millions of 401ks and automated apps execute a buy order. They aren't price-sensitive buyers. They don't care if oil is high or if there's a war. The algorithm doesn't have feelings. It just has a schedule. Behind those ETFs are the high-frequency trading algos that know exactly where the buy-the-dip crowd is going to step in. They front-run the recovery, bidding the market back up in milliseconds before you can even refresh your brokerage app. We've automated the bottom. We've turned the stock market into a self-healing wound. So is this a happy ending? Well, here's why my opinion gets a little darker. We haven't actually deleted risk. You can't delete risk in a capitalist system, you can only move it around. What we've done is compress time. By making the market uncrashable in the long term, we've turned it into a coiled spring. When everyone is positioned to buy the dip and the bottom is guaranteed by the government, the market becomes incredibly fragile to the unknown unknowns. We've traded the 2-year slow bleed of 2008 for the 2-week violent crash. When the dip finally comes, that is too big for the M2 floor to crash. When the government backstop fails or the algo loops break, the drop will be faster and more violent than anything we've ever seen. We're building a higher and higher tower on a foundation of pure liquidity. So here's the question. Is a market that cannot stay down a healthy market? Or are we just building a tower so high that we've forgotten what the ground even looks like? The bear market isn't dead because the world got safer. It's dead because we've rigged the system to never stop buying. But gravity is a patient law. It might take longer to kick in, but it never forgets. I'm Balaji. This is just what I'm seeing. But I'd love to hear if you think we've actually beaten the market or if we're just feeding it more than ever. See you soon the next time.